Welcome to this webinar on the Bluewater apartment homes at Bolton's Landing out of Charleston, South Carolina. We're really excited about this particular investment offering, and so we've dedicated this webinar to discuss with you all the different details surrounding this particular acquisition. And as you are joining us here live, what we'd like for you to do is find the chat box or the Q&A box, whichever you'd prefer. We'll monitor both of them. And as you have questions, go ahead and type those questions in, and we'll try to get to as many of them as possible between now and the end of the webinar. The target time for this webinar is going to be about 30 to 40 minutes, somewhere around in there, give or take. We do want to make sure that we answer as many of the questions that you have already. Several of you have already submitted questions to us. We'll make sure that we answer some of those if we can. And then many of you have already submitted your soft reserves. So this particular offering is filling up fast. So if you're interested in investing, make sure that you click the soft reserve button that was emailed to you when you were notified about this particular webinar as well. So let me go ahead and do this first. Let me go ahead and bring us over to this next slide. So this is our disclaimer slide. This is a slide that is inside of your actual investor offering memorandum or pitch deck, if you will. And so if you want to pause the video right now, if you're watching the recording, or later on, you can go to this page. You can review this. You can. This is just our legal jargon, things like that. So feel free to do that. This slide also contains the direct phone numbers of all three of the managing partners here at passiveinvesting.com. So whenever you have a question, if for some reason you need an answer right away, obviously you can reach out to one of our team members directly in our investor relations department. Or if you want, you can reach out to us directly, because we want to make sure that you, as one of our investors, feels like you have that direct access to us. If you have a question, or if you have a problem, if you need us for anything, that's the transparency that we give you. That information, that those phone numbers go directly to us. And of course, you can also see our direct emails there as well. So let me go ahead and do an introduction of myself, and then I'll turn it over to Danny. We do have Danny with us today on the webinar, as well as Brandon, and then they'll do their introductions after mine. So I'm one of the managing partners, as I mentioned earlier, of passiveinvesting.com. I live and work here in Columbia, South Carolina, along with my wife and our 4 children. We have 4 children, 10 and under. We have a 10-year-old, 9-year-old, 4-year-old, and 3-year-old. And so life is definitely busy here in the Hanford household. We also have a dog, a standard poodle named Bella. So I have, and just of those 4 children, I have 3 girls and 1 boy. So the boy is the kind of is the second oldest in there. And you'll hear in Brandon's introduction that our children are actually friends. They go to the same school together. We also attend the same church together here locally in Columbia, South Carolina. My background has primarily been in business, and my focus here has been is on the investor relations piece at passiveinvesting.com, as well as on marketing and the strategic objectives of the company. So that's a little bit about me. I'm going to go ahead and turn it over to Danny, let him do his introduction, and then when he's finished, he will turn it over to Brandon.
I am Danny Randazzo, excuse me, one of the managing partners at our company, passiveinvesting.com. Thank you for joining us tonight to talk about this opportunity. I actually live about 15 or 20 minutes, depending on traffic, from this asset with my wife and our daughter in Charleston, South Carolina. We have a golden doodle dog named George, and love taking him for walks around downtown Charleston and just enjoying life outside and being outside as much as we can. Prior to joining the company here, I was in financial consulting. I traveled around the world, worked for one of the largest sovereign wealth funds, the Abu Dhabi government in the United Arab Emirates, for about a year, and then was predominantly focused in traveling around the country, helping multi-billion-dollar companies improve their financial performance, which leads me to a perfect fit within the financing side, and really everything related to the numbers and the underwriting of our assets that we currently own and any assets that we are looking at acquiring. So that is my main focus on the company, is working on the financial lead side of things. So with that, I'll turn it over to Brandon, let him introduce himself.
Good evening, everybody, and whatever time you will be watching this recording, if you're not watching it live, thank you for joining us. My name is Brandon Abbott. I'm one of the managing partners at passiveinvesting.com. As Dan mentioned, I reside in Columbia, South Carolina, just about 15 minutes from where Dan is located. It's a very close proximity. I have 4 daughters, 16, 14, 13, and 10. And they do attend the same school with Dan's children. And as he mentioned, we go to church together. My hobbies are really family. That's where I spend most of my time. My girls are involved in all kinds of musical endeavors, cello, violin, viola, piano, and they all play sports, soccer, volleyball, basketball. So I'm always going to and fro from those activities. So that's really my hobbies now. And in my free time, I'm a huge soccer fan. So I coach where possible and spectate whenever possible as well. My background before passiveinvesting.com was in general contracting, construction management, and then also in insurance adjusting. So I've handled property claims all over the Southeast, hurricanes and fire damage and different things like that. So I bring a vast knowledge of the construction industry and estimating and looking at the bones of the property. And I apply that in the acquisitions field at passiveinvesting.com. So I am out building broker relations, working with our acquisitions team, trying to find these great assets like Bluewater and bringing them to you, looking at the bones, looking at the business plan, and working with Danny to see what are the best options to achieve the best returns. So we're excited to bring this opportunity to you tonight, and we'll go ahead and hand it back over to Dan.
Awesome. Thank you guys for the introductions there. So let me first tell you before we dive into this property, just a little bit about Charleston. And I will tell you that Charleston has been a very challenging market for our company to be able to get inside of as far as acquisitions are concerned. We've been looking for several years now. And of course, with one of our managing partners being there in Charleston and having some boots on the ground there, we figured it might be a little bit easier. But Charleston has been booming and growing, and it is continuing, and it is poised to continue to do that same growth, if not even more, over the next 5 to 10 years. I'm going to go over some stats with you so you can see what that's like. But I just wanted to tell you that this asset is a very unique asset. And I know Brandon's really excited about this acquisition and being able to secure this. I'm sure he'll share some of that story and that excitement when he goes over his side of things here in just a few moments. But this particular asset was a great find. Once our property management company heard about us getting this particular property, they were really excited because they actually manage a property, an apartment complex just down the street from this, which is already proven out our business model and our business plan on this particular property. So we're really excited to be able to see this property go forward and be able to acquire it, to be able to provide a lot of value to you as our investors as you actually invest in this particular property. So a couple of things I wanted to point out on this slide. I know a lot of these slides are already in your investor offering memorandum. And as a quick reference, on the bottom left-hand corner, you'll see these page numbers. These are not the page numbers inside of the slides that we're talking about today. These are specifically the page numbers that are in your investor offering memorandum. So if you want to go back and reference these slides, you can certainly look at those page numbers and go back to that a PDF document that is electronic. You can go through and actually see a lot of these in more detail. But you can see here, it's been for the 8th consecutive year voted as the #1 best city by Travel and Leisure magazine. So it's great to have Charleston there, making that list 8 consecutive years in a row. Top 10 best places to live. South's best city, #10 U.S. city gaining innovation jobs. So a lot of times we think of Charleston as being kind of touristy because of the beaches and the different islands that are around Charleston, and just a lot of the history that Charleston brings as well. But there's a lot of additional things that are happening there. And we're going to go over that here in a little bit when it comes to some of the additional jobs and manufacturing that's actually happening in this particular area. And of course, you also have the Port of Charleston there too, which provides a lot of jobs and a lot of kind of growth around this particular area. But then I want to point this out and point out a few things for you there. You can see there at the bottom in those 3 boxes, you can see that the historical annual effective rent growth is 3.61%. This year is poised to do even higher than that, which is great. But we also, on our underwriting, we didn't say, okay, let's go ahead and do a 3.6%, effective annual rent growth, even though historically that's what we're seeing. We wanted to make sure that we were conservative. So in our underwriting, we underwrote less than that 3.61%. I believe it was around 3.2% that we ended up projecting as far as the annual rent growth. And that doesn't actually go into effect until after the stabilization period, once we're done with renovation. So it actually has a little bit of extra conservatism and buffer built in because of that, because of the way we actually underwrite and the way Danny has set up the model there. The 5-year multifamily average physical occupancy of multifamily assets in Charleston is 94.5%, and it is projected to continue to do that. We actually underwrote this for 93%, so it was a 7% vacancy after stabilization. I think even during stabilization, although during stabilization might have gone it up to 8%. I'll have to double check that. Maybe Danny or Brandon can do that while we're talking here, and they can bring it up during their session. But anyway, so I wanted to bring those two stats up for you so you can kind of see that from this particular slide. I'm not going to read all this to you. I know you guys know how to read. You can go through these slides and then review them in more detail yourself. But this is a slide that talks about some of the manufacturing jobs. So obviously we have Boeing, which is a major employer there in the Charleston market, 75 plus aerospace companies located in the Charleston MSA. 22,000 are direct and indirect jobs directly because of Boeing. 1,600 jobs because of Mercedes-Benz. Another 1,600 because of the SUV, the Volvo SUV plant that's being built right now. Should be completed soon. And you can see there, 45 average new residents are pouring into Charleston every single day, which just continues to prove the business model and the plans as to why we like this asset. And and Brandon will go over some reasons from a location perspective as to why a lot of people like this particular area when it comes to Charleston too. So this particular property is a 350 unit property, 3-story garden complex called Bluewater Apartment Homes at Bolton's Landing. I'll have Danny go over some of the offering details on the right there whenever he goes over his financial analysis on this. But this slide is here to also remind me to tell you that this offering is only available to accredited investors. And an accredited investor is basically somebody who has a net worth of $1 million that does not include their primary residence, or an annual income of $200,000 if you're single, or $300,000 if you're married for the last 2 years, and you have a reasonable expectation that it will continue. So those are the two primary ways to be able to qualify as an accredited investor. The way it works with our group is that once you soft reserve for a property, for this particular investment offering, you will receive a PPM, a private placement memorandum via email, via DocuSign that you'll review and sign. Once that's signed off on, inside of that form, it'll ask you, how do you want to verify to us that you are an accredited investor? And you can do it by either having your CPA, financial advisor, attorney submit a letter stating that you're an accredited investor. And there's template letters that we have, which you can reach out to our investor relations team to be able to get those template letters. And you can send those to you, so you can send those off to your professionals to have them done. Or you can do it through a third party called verifyinvestor.com. And you don't have to pay for that. So we'll set it up for you. Once you actually fill out the PPM and sign off on it, our team will put that into the Verify Investor system, and Verify Investor will reach out to you. Should only take about 1 to 2 business days to be able to get that process completed. It's pretty straightforward. And then, of course, the third thing is if you've already invested with us before, which I know many of you have already invested with us, we usually have about a 60 to 70% repeat investor rate at each one of the deals that we do. So if you've already invested with us in the last 5 years, then you do not have to give us another accreditation letter. So that's a good thing for you. We just keep those on file, and they're good now for 5 years. That was a recent change that was made as well. So let me talk about the 2-tiered investment structure that we have. If you've been following us at all, you've probably seen that we do a 2-tiered structure. We have a Class A option, which is 9% paid out on a monthly basis. And this particular tier is only going to be about 21.6% of the total equity stack. And the rest is going to be for our B class shares. The Class A shares have a higher preferred return. And you can also see there in the capital stack structure that it actually sits lower in the capital stack, which means it has a higher preference when we're paying out from cash flows or when we actually sell the property. So the 9% with it only being 21.6% of the total equity stack, is as close to a guarantee as you can get when it comes to these types of returns inside of multifamily. Now, it's not a guarantee, right? These are investments, so it is not guaranteed, but it's as close to a guarantee as you can get when it comes to these investments, because Class B doesn't get anything until Class A is completely paid out on their actual 9% preferred return. And of course, when we sell, same thing. They have to be made up in any lagging preferred returns, if there are any, and then they also get their capital back first as well. So you'll see how that's laid out inside of the private placement memorandum that'll be emailed to you once you actually soft reserve for this investment. It does have a $100,000 minimum to be able to invest in Class A, but you can also mix that up. You can do a blended option where if you want to put, say, 75,000 in Class A, 25,000 in Class B, you can certainly do that. And so those will be options that'll be available for you as you are filling out those forms. Inside of Class B, it is actually going to be a 7% preferred return. And then any of the cash flows over and above that 7% are split 70-30. And then once it reaches a 13% IRR, it splits 50-50. 70-30, 70% going to the LPs, you as the investors, the limited partners, 30% going to us as the GP. And then, of course, on the Class A, I think I mentioned this, but the Class A does not participate in any of the upside. So the maximum return you will get is that 9% preferred return. So the Class A is really designed for somebody who really wants those higher monthly cash flows, and they want to sit in a better position in the capital stack and that's why they're giving up that extra percentage to be able to do that. So there's no participation in the upside for Class A. Class B, of course, does get the participation in the upside. And let's go ahead and go over to this next slide here and talk about this for a moment. I will go back and talk about the investor bonus because I know we've had some questions already come in about the back end bonus that we're offering for those who are investing $250,000 or more in this particular deal. So let me see here on this particular thing. I wanted to point out on this particular slide, I wanted to point out to you, let me get my spotlight here. Obviously, you can see the Class A structure in this table here. And then, of course, our Class B structure here. You can see the year 1, 2, 3, 4, and 5 cash flows. You have 4.6% the first year, 7.1% the second year. And of course, you can see that in years 3, 4, and 5. Now, of course, the first year is lagging behind the preferred return of 7%. So we always do what's called a cumulative preferred return. So whatever is missed one year, it gets added on to subsequent years until it is made up. You never lose that preferred return. It just will build up or accumulate over the years. So in years 2 and 3, you'll be continuing to be made up. Same thing in year 4. And so you'll actually see that over time as that's out from our current projections. Now, of course, as we're trying to build out this property and implement the business plan, our goal is to be able to outperform these projections because we try to be as conservative as possible. So it is possible you can get more than that 4.6, the 7.1, 7.6, the 8.4, the 8.6 years 1 through 5. But this is what we have for the projections at this point. Now, the table below on the bottom here is for Class B primarily, because Class A, as you can see here, is just a straight 9%, 1.45x. 9% cash on cash, annualized 9%. So it's pretty straightforward because that is the max which you will get. But we try to do a couple of sensitivity analyses here so you can see the actual middle cap rate here of 4.2%. These are actually exit cap rate scenarios. So depending on when we sell the property, where the exit cap rate is. So we wanted to show an expansion. So if the market softens a little bit and goes up, so that's a 50 basis expansion. So we typically try to underwrite for about a 5 to 10 basis point expansion for every year we're in the deal when we're doing an exit cap rate sensitivity analysis. And you can see that there, the 4.2, 4.45, and 4.7. And if you go over here, you can look at your annualized return, 15.4%, all the way up to this 28.7% is the potential here. And the 4.1% exit cap rate and the 3.95% are if the market continues to perform well and continues to outperform our projections. Of course, that's what's going to happen is the cap rates will compress and it will allow us to have an even greater exit potential when we actually are exiting this particular property. But if we just maintain and we just exit at our entry cap rate, you can still see the returns are pretty nice. 18.4% IRR, 2.19x equity multiple. Still a cash on cash is the same each time because it doesn't matter. That's just the hold period. And then the annualized 23.8%. So again, this is a phenomenal asset to be able to find. And Brandon is going to be going over with you here in just a moment some of the value add things that we're going to be doing on this property. I know some of you are thinking it's Class A. It was just built in 2017 and 18. So how can this already have value add to it? And let's just say there's some contractor specials that are happening inside this property. And Brandon will cover those and share with you what our plan is to match the competition that is in this particular market. And that's going to allow us to be able to capitalize on some rent growth that has really not been happening on this property because the actual owner of this property has not been managing it very well and has not been keeping track of the local surroundings in this particular market because they are an out-of-state owner. So we know this market very well. So does our property management company. So we're really excited about doing this. So let me go back one slide here. Because on this last slide, we have this investor bonus. And I know several of you have been asking about this. And so if you have, we've had several people asking us about this in the past. So we decided to go ahead and offer this because this property has a lot of extra things that we're going to be able to do to it from the value add perspective. And we feel like we've been very conservative. So we feel like there'll be a lot of extra opportunities there from on the GP side to give up some of our GP equity to those that wish to put in a little bit more to be able to get that bonus. And so if you invest in Class A, then you'll get a 1% bonus to reach a 10% annualized return when the asset is sold. And so the way this Class A bonus works is you're still going to only get your 9% preferred return during the hold period. But then when we sell the property, that's when you will get made whole on the extra 1%. And it will be a 1% annualized that you'll be made whole on when we actually exit the property. So you will effectively have gotten or received 10% annualized return for that large investment of $250,000 or more. For the Class B investors, there's a 20% bonus on the back end equity when the asset is sold. And the way this 20% back end bonus works for those that are investing $250,000 or more is if you take the 70% split that you're getting right now, and you multiply that by 1.2, which is 20% on top of the 70%, it's not a straight 90-10, right? That's not what it is. It's a 20% bonus on the 70%. So you take that 70%, you multiply it by 1.2, and that gets you 84% for the Class B investor. Now, the other thing you can do is obviously that's for the first part of the waterfall. And then if you take the 50-50 split and do the same thing, you take that 50%, multiply it by 1.2, then you're going to get a 60-40 split on that, the rest of that past the 13% IRR. Because originally for the Class B investors, there's a 70-30 split up to after the preferred return, up to a 13% IRR, then it splits 50-50. But if you invest 250,000 or more in this particular offering, we are on the Class B going to give you basically an 84-16 split on the first tier. And then once it reaches 13% IRR, then it'll be a 60-40 split. So if you have some further questions about that, I know sometimes it can be a little bit confusing. Hopefully inside of the PPM, it'll be explained a little bit easier so you can understand it a little bit more. But we are offering that bonus for those of you who wish to invest 250,000 or more. I'm gonna go ahead and move on from here. Go ahead and close out this, move on to the next slide. All right, I'm gonna go ahead and turn it over to Brandon at this point and have him go ahead and go over his slides that he has. And then when he's finished, he'll turn it over to Danny for the financial analysis. And then we'll open it up for some Q&A at the end.
Thanks, Dan. All right, so I'm very excited to talk about this property. It really, as Dan mentioned, it's been very difficult to get into Charleston. It's a very popular market and has a lot of demand. And for us to work with our broker relations and find this property at such a great basis we're very, very excited. Feel very conservative. And as Dan mentioned, we just feel there's so much value to be added here. We're just very excited about it. So 350 units, average unit square foot is 1,062. Of course, that's the average, and we'll talk about the unit mix later with 1, 2, and 3 bedrooms. So your 3 bedrooms are obviously much larger, and our 3 bedrooms are going to be kind of where you would, if we were in a comparative price point, lose people to single family housing, but we'll look later at how that's not really going to be a factor for us here. Built in 2018, this is going to be a little bit of a challenging thing that we're going to explain a little bit. This was built in 2 phases. The final phase was delivered in the end of 2019. So the planning for this occurred right around 2014, 2015. And this market was definitely not as developed as it is currently. So again, we'll touch on that a little bit more when we get into the value add. Occupancy rate now is 94. It's actually a little bit over 94. I think our last financial was 95%. So that's over the average market occupancy, and we are underwriting an 8% vacancy to confirm what Dan stated during stabilization. Stabilization is the time that we're trying to execute the business plan. So we want to do all of our value add and raise rents during an 18-month period. And so we're underwriting an 8% vacancy during that time period, but the property's already achieving higher than that. And then our stabilized is rated at 7% vacancy. So very low density. You see the 78 acres is a very large property. It's in an HOA, the Bluewater kind of submarket right there. There are some single family homes and some common roads that access the property. And it makes it very convenient to get out two different directions, back going down 17 back into Charleston or out, and I'll look at the map in a moment. Average market rents are trailing by a significant amount at $1.41, and average market rent is $14.98. So go on to the next slide. All right, this is kind of gives you an idea of downtown Charleston. You see the peninsula right there. So this is just off the peninsula. Downtown Charleston there's less growth there. It's a peninsula, right? So you're kind of landlocked there. So the growth pushes out from Charleston. If you're familiar with South Carolina at all, it's seen exponential growth. I think it was over 500,000 since the 2010 census. And if you know South Carolina, all that population is pretty much divided between Charleston and Greenville. We're in Columbia, Dan and I are, and the population doesn't grow that much. So most of that population growth is going to these two areas. And the population cannot any longer be sustained within the peninsula, so it pushes out. And so this is the West Ashley submarket, right up Savannah Highway, and then you see 526 going up kind of in the middle there. That's kind of the loop that goes back around to Mount Pleasant on the other side of the peninsula and over the bridge that y'all are so aware of, the beautiful Charleston Bridge there. So great location. All of the jobs, or most of the jobs, are right there up in that northern kind of Somerville, Ladson. A lot of the tech, a lot of the aviation, Volvo, Boeing, and all those are up in that area. So it makes it very convenient. And if you look at kind of what I was talking about, you have two exit points. If you go right down Highway 17, you see Bluewater apartment homes kind of on the left there, and you can go turn left out of the property and go down 17, or you can cut through and go up to Bees Ferry Road and go down Glen McConnell. So depending on traffic and which way you want to go, that's the way you get into downtown to the restaurant scene and the beautiful Rainbow Road that everybody knows so well. Or if you want to get to 526, you can do either 17 or Glen McConnell, get up that way, and you can access the airport, which is just off the screen in North Charleston, and then up to Somerville, and then you can catch 26 back to Columbia, Greenville. So it's very, very convenient, great location. If you look down at the bottom, you'll notice some time frames and access. So you want to really look at like Bon Secours St. Francis Hospital, 10 minutes away. You've got the Citadel Mall and MUSC Pavilion, 15 minutes away. Downtown Medical Campus, MUSC, 20 minutes away. Downtown Charleston, 20 minutes away. And then you've got your more touristy destination, Kiawah Island, Folly Beach. And then you have Joint Base Charleston and Boeing, only 20 minutes away for Boeing. A lot of job growth there. So very excited about where this is located. I'm very familiar with the Charleston area, having covered this area with insurance claims for years and years. So I have been right in this area looking at claims. I've actually covered some claims right in the single family neighborhood right next to Bluewater. So when I saw this, I knew exactly where it was. And Danny also can speak a little bit about the great location here. So we can go on to the next slide. All right, and so we want to point out we talked about the single family homes right there across the way, and you can see it's literally right across the streets, part of that same master development, if you will. Average monthly payment there is going to be $2,200 to $2,600, whereas our market rents are $1,498, and that's average over the 1 bedrooms to 3 bedrooms. And so we're really not looking to lose people to single family homes, especially now since those prices have gone up even more. The single family house demand is great in the Southeast. It's very difficult to find homes. People are buying them, sight unseen, over asking price. So people are more and more sticking with renting due to the single family market. So we can go on to the next slide. All right, so value add. I know a lot of people have talked about, why. A lot of questions have come in already. Why are we doing a value add on a 2019 product? And again, we talked about how this property was planned in the 2014, 2015 time period, and it came in 2 phases. So at that time, Granite was above market, and the rest of the features, so the black appliances were market, but this has seen so much growth over the years that it has now in demand more, and some of the other comps have nicer amenity sets, such as stainless appliances and different light fixtures. So we're really just looking to bring it up to that level, and the units are lagging the market rents significantly, and so we just feel if we can just add those few little touches, very minor things, stainless appliances, some upgraded fixtures, paint, different things like that, we can easily achieve what we're seeing in the sub market. So new stainless steel appliances, modern lighting package, ceiling fans, because they just had the single incandescent lights in the bedroom. So that's really something you don't see anymore. So it's kind of a commodity built property. This is an owner operator. They do develop, but they also build in or buy in place. They're kind of a little bit newer to the development scene. Didn't really have the high end finishes, but again, when they were planning this, that was common for the submarket. Improved paint scheme, obviously that's something we do on all of our properties, and then solid surface flooring in the common and wet areas as needed. Most of the kitchen and bathrooms already have that, and as you see, there's granite already in the kitchen. I think the biggest upgrade that we were looking at too is also in the bathrooms, where they have Formica tops and kind of a porcelain sink set inside of that, and that just really is not really seen anymore in this Class A property. As you saw in the pictures, is a beautiful exterior. I mean, very southern coastal feel, very low density, very residential, and then you go on the insides and it just doesn't match up. And so we really want to take it to that level and think we can exceed what we've projected. I know that we'll be able to do so. So if you want to go on to the next one, this is kind of usually what we do in our renovations. Typically, the cabinets color change, we don't intend to change so much because that is a cost that we don't think we need to spend. So you see the granite, you see the updated kitchen appliances, the stainless steel appliances, the tile backsplashes, and the gray paint scheme. And those will color coordinate with our designers to make sure everything flows well. But this is a reference of one that we've done in Raleigh. This is kind of the renovation that we've done in the past. And so it gives you an idea of kind of what we want it to look like. Very light, very bright, very modern. The unit mix is very typical, low percentage of 3-bedroom, 2-bedroom, 57%, 1-bedroom, 35%. So your average rents are skewed greatly on that number. Your 3-bedrooms, again, is really where you're going to see anybody that's wanting to move into single family. That usually coming out of the 3-bedrooms, but those are the most in demand and have the highest waiting list and also the highest rents. Luxury amenity upgrades is really a great property, really beautiful. Just needs some light touches. So modernizing the fitness center with some possibly new equipment and upgrading some paint. Just seemed a little bit worn when we got in there. Didn't really maintain it really well. So just touching that up. Pool and sun deck upgrades. You see, there's not very many umbrellas there. No cabanas, no power outlets there. So we want to make sure that we're providing what we need. Adding additional dog park. The one there was very, very small, and this is a very large property. So adding a secondary one. Expanding the outdoor community spaces. This is going to be something where you want to focus on retention, and having community events is one way to do that. So having some food trucks come in, having outdoor movies. There's a lot of space on the property. We want to be able to utilize that. Screening in all unit porches is very important in Charleston. We do have mosquitoes, and so we plan to screen in all the porches to give that extra. And that's something that we are seeing on our comps that are achieving much higher rents. Creating private yards as necessary or possible. That's something we'd like to do if necessary, but we haven't really underwritten that additional income. So these are a lot of possibilities that we see in the submarket that we haven't really put in expecting that income. So there's a lot of room here. New package room and upgrading the landscaping throughout the property. The landscaping was poorly maintained when we were on site. There's a lot to be desired there as far as just the maintenance is concerned, and then just bringing that back up to that Class A feel. And go on to the next slide. All right, and from that point, I will leave it to Danny.
Perfect. Quick summary here, just from an overall cap rate perspective, based on the adjusted T12, we're entering and acquiring this property at a 4.2 cap. The return summary is based on that page 15 in your full package. So I'm not going to go over that today, but when you get it, look at page 15. That'll give you a range of return metrics based on expected exit cap rates. The expense ratio, 37%, occupancy, 94% as of 7/7. And I know occupancy has gone up since that date. DSCR 1.24. Purchase price 85.85 million, 5-year hold. We're going to raise about 27.8 million in equity split across Class A and Class B. And let's move on to the next slide, please. We are going to go with a private loan for this. We expect to get about 78% loan to value, and that's about a $70 million loan, just actually closer to 69 million. And we expect the interest rate, it's a very competitive debt market right now. I expect that to continue just with all of the economics in the market, with the government also really trying to keep the 10-year US Treasury and overall interest rates low. So 3.45%. We've been able to close some of our more recent deals at or below this number. So I feel that we're being, again, conservative in getting this interest rate. 60-month interest only period. It's a 3-1-1 term. So we have the option to extend, or once we complete the value add, it may be a good opportunity to refi into a longer term debt. So this one, it will be an adjustable rate. We will be purchasing an interest rate cap to mitigate any interest rate exposure if rates do go up. And it has a controllable prepayment penalty at about a 0.5 point. So that's advantageous if we do end up wanting to refinance the property sooner rather than later. All right, bear with me on this slide. This is one of fairly good importance as we talk about all of the financing on this property. So what I like to do here is we're going to kind of look at 2 columns. So don't be overwhelmed by all of the information on here, but I do want to go through the T12 and kind of compare it to our year 1. And we'll kind of look at year 2, because this is an 18-month projected stabilization. The value add improvements that we'll be doing to the interior of the unit and also around the exterior, some of those common area amenity spaces can all be accomplished within 18 months. So as you'll see, gross potential rent, that top line number, T12, is at 6.2 million. In year 1, we expect to renovate and rent out some of the units and increase the gross potential rent to 6.5. And then in year 2 is really where we realize a full bulk of that effort in rehabbing all of the units on the property and getting our gross potential income up over 7 million on an annual basis. The other income right now, the property is generating about 700K, and we're really not assuming or underwriting a major change for that. It's really just getting the occupancy and renovating those units. We're going to see a small bump in other income. As Brandon mentioned, we do have some opportunity to, screen in porches, charge a premium on top of the base rent for those units. So really kind of conservative approach to this. By year 2, we do expect to get a little bump in the overall performance of other income, really just from a management optimization. Loss to lease. This property, one of the only properties I think we've looked at this year that does not use a robust property management software. And it's one of the reasons why the property does trail in rent comps. And I'm going to get to that slide and talk about that. But basically at the property, what they do right now is the on-site manager will manually price what each unit should rent for. By doing this, they are missing a lot of the market comparable data because they don't have a robust software to help give them pricing guidance. So at all of our properties, we use a daily pricing tool, which basically aggregates the data from the market of what a 1 bedroom, a 2 bedroom, and a 3 bedroom should rent for based on what all of the other property comps in the area are renting for. And so we're able to price to market every single day that we have a unit available, and this property is missing out on that. So they don't really understand what the units next door or down the street are renting for, and that's why they're missing the mark. So in addition, our daily pricing tool eliminates the loss to lease because the market rent changes every single day for the property. So we don't have this loss to lease number to account for because of the daily pricing tool and the robust software that FCA will use to manage the property. Vacancy. This is again just one of the things that we do to be conservative. So 266,000 in the T12. We're basically doubling that to about 500,000 in years 1, 2, 3, 4, and 5. Again, it's just our conservative way of underwriting the deal, making sure we have cushion in what we're doing with the business plan. Concessions and non-revenue pretty much in line over year 1, and then bringing it down in year 2, again just by optimizing management performance. So overall, that's where we're at from an income perspective. A couple of small changes. Again, the real pickup that we're seeing in the effective gross income is from that improvement to the interiors and getting rents up to market. That's the big game changer and the value add component for this property. From a payroll perspective, from a contract services, from a contract services perspective, we're expecting to have an increase in those. I think one of the reasons why this property is underperforming today is in that payroll bucket on their T12. So they're trailing the market. I know at least for this year, the property has not had a full-time manager in that position. The company, it's a family-run business. They have a manager who flies in and out of Ohio to come to the property a few days a week. And so we will see a pickup in payroll and contract services. We'll see a little bit of a reduction in R&M because of the value add that we're doing. So we won't have as many repairs and maintenance items to address. Turnover, we are expecting a decrease in turnover again because we are already planning to renovate the units. We won't have an added turnover cost, so we will see a reduction there. Utilities, we're going to see a pickup in utilities, administrative, marketing. We're just going to align with what FCA is already doing. They manage many assets for us. And so we have a good number and a good budget for how to effectively spend marketing dollars and get the best benefit for property performance by, again, maximizing occupancy and keeping that balance of market rental rates. Insurance, very much in line with the T12. Management fee, that's just our preferred piece. From a property tax perspective, we will see an increase. Charleston County, just like all of the other assets we have in South Carolina, reassess at the time of sale. So we've got that calculated in there. We'll be spending just over $1 million a year on the tax bill for this property. And that's really the major piece. So from a high level, not a huge difference in operating expenses overall. The big change and the increase in total operating expenses really comes in from that tax reassessment number, which we've seen in pretty much every deal that we've acquired. We've always seen an increase in taxes, and so that's really the high level plan. It's a conservative approach to the opportunity we have ahead of us. And so I feel, confident in the numbers and the performance of this property to be a solid and sound investment. Let's go to the next page, please. Now, I'm going to spend a little bit more time than normal talking about the rent comps on this one. The Bluewater at Bolton's Landing, that's our asset. So the average rent per square foot, again, a lot of columns here. I just want to talk about one, and it's this average rent per square foot, $1.41 per square foot. And if you look at all of the rent comps on this page, we are the absolute lowest. If you've looked at a couple other deals we've done so far this year, we have not been the absolute lowest on the page. We've always been, 3 or 4 or 5, but never the absolute lowest. So again, this is a conservative value add deal. We've got a lot of room to move. The most important comp on this page is this Bees Ferry Apartments. It's around the corner. It's a great comp to this asset, and they are at $1.65 per square foot. FCA currently manages this property, and so we've got a great insider's knowledge of what folks are willing to pay in the Charleston market. So again, if you look at this asset, Bees Ferry was built, in 2013. Our asset is a little bit newer, a little bit nicer, and it certainly will be nicest once we complete the value add for those interior units. So we've got a great solid runway to move to bring those rents up to market rates. And again, if you go back, either pause the webinar and rewind to the T12 pro forma summary on the previous page and look at those income projections. Again, that's why I said we're being conservative here. We've got some good runway to increase the value of this asset just by bringing rents up to market. So again, trailing the lowest in the rent per square foot, which is a great thing for us to buy this asset and increase rents for the property across all of our unit types here. Next slide here, the sensitivity analysis. One of my favorite things, a 55% break even. What this means is how much occupancy, how many people need to be living at the property and paying rent on a monthly basis for us to break even. So if we have 55% of residents paying their monthly rent, we will be able to pay all of our expenses and our debt service. So again, with the property being 94% plus occupied, if we break even at 55%, we have a very good opportunity to cash flow this property and have those monthly distributions. So it's just another conservative investment opportunity. The cap rate table, you can see there the varying IRRs. I would suggest you look at page 15 of the full offering memorandum so you can see all of the other return metrics that you'll be interested in. Let's go to the next slide, Dan. FCA management, we've got a great relationship with this team. We are grateful to be partners with them. They manage all of our assets in North Carolina, our assets in Florida, and they manage a property right around the corner from this one at Bluewater. So very grateful to have them working with us. They have a lot of experience and do a great job for us. So it'll be a good fit for them. Let's move to the next slide, please. With that, here's our faces and our team again, and we will go to questions. While I have Dan queue us up for any questions, gentlemen, was there anything I missed that we needed to add in?
I think we covered most of it. I'm sure there'll be some questions that'll come in after the webinar because there's always some things, little nuances here and there that need some clarification. So if you have questions for us, right now is the opportunity to type them into the chat box, and we'll try to spend a few minutes here answering some questions. If you have something more personal and you want to email one of us, obviously our emails are there on the screen, or you can reach out to one of our team members inside the investor relations team that can help you out as well. Brandon, I do have one question that's come in here from Tim, and he's asking, will the units that are updated, will they also include new microwaves? Because obviously in those pictures of the current units, they have the microwaves over the stove. But in our that Raleigh property, of course, you could see in those pictures, it did not have the microwave.
Yeah, it will include a new microwave if it already has it. The rendering photo from our Raleigh property, they did not already have microwaves, and we didn't feel it was advantageous to add that extra cost. But that's just the photo kind of the finishes that we're using. But yes, if there's a microwave there, we don't want to leave that black microwave there and have all the nice stainless appliances. One of the big things too on the appliances that Dan was there on the tour with me that you noticed when you walked in, they had the hole where the refrigerator goes, and they had a very tiny little fridge, something you'd see in like, I don't know, a cabin. And it didn't fit the hole. And there's about a foot on either side space of that thing. And really you could go with a nicer stainless double door fridge, kind of more like standard size that you'd see in a residence. And so that's really what we're going to go for on this, and just make that the nice residential feel that this property has.
Yeah. And maybe you can opine a little bit, as we have a couple of questions that are coming in here as well. If you can opine a little bit, Brandon, on the cap rate that we're buying this property at, and kind of Charleston, and kind of the per door basis and everything.
Sure. So we, as on the acquisition side, we work on many, many deals. We look at a lot of Charleston deals, and we have been looking at Charleston deals. Matter of fact, the very first deal that this passive investing team ever looked at when we started talking about getting into business together was in Charleston many moons ago. And so, and it was in the same submarket, actually, in the West Ashley submarket. So we know the market well. We know what properties are selling for. We have lost many, many properties in the submarket because of the per door basis price and the cap rate that they were projecting. When this property came up and they told me the price and we did the underwriting, we were, thought there may have been a mistake from the broker. So we jumped right on, did all of our research and submitted actually early on this property and took it off market before the process was done. So this was not scheduled to be sold for another 3 weeks or so. And we knew the value of the property immediately and pulled it down the day after we toured the property to send in an offer on that. But to talk about the cap rates. So this one, we're coming in at a 4.20 is what we're underwriting. The last three properties that we've looked at in Charleston, I'm not going to give the names of them because some of these are not sold yet. And so I don't want to, we have to sign confidentiality agreements, and I don't want to disclose any of that information, but these are actual cap rates that I pulled up from our underwriting rate for this webinar. So 4.05, 4.15, and 3.75 are the last three cap rates for properties that we were looking at. And another question too that goes right along with that is the per door basis. Like $245 a door, that sounds really, really high. And again, this is in Charleston, West Ashley, and Somerville. We were seeing properties selling for well over $250. And in Charleston, in the North Charleston area, which is outside the peninsula too, up by the airport, which is really not that great of an area, $270 a door. We've seen stuff move. And so we're below market for this property is on a per door basis. And we are at a more expanded cap rate than the market is showing. So very, very, very happy with where we're buying this property.
Another question that's coming here for you, Brandon, as well, is about how many of the units will actually have the screened in porches in the back.
Okay, so 100% of the units with the patios will have them. There are some units that have a walk-up porch. If you saw on some of the photos, they have the parking right out front, and you can walk right to your units. Those we're not able to screen in because they're just direct access. And they have garages. Some of those have direct access garages or a secondary entrance out into the breezeway, but not a patio. However, on those units, they're not charging a premium to park right in front of their unit on street side parking. So where we're unable to charge an additional rent premium for screen-in porches, we're going to charge for the premium of pull-up parking right in front of your unit with designated parking. But every unit that has a patio is going to get screened in. And that's something that they are doing at Bees Ferry as well. That's something we'll mention, and that's why we included it in the underwriting.
Yeah. Another one here is directed to you too, Brandon. You're just popular during this webinar, I guess. Are we going to be planning to add any of the Wi-Fi products that we have on some of our other properties to this property?
That's a great question. And we are not planning to do that here because there is a cable contract in place. We have looked at that contract and there is no way to terminate it early without paying damages. And however, the rent or the premiums that they're achieving with the contract are very similar to what we could achieve through our Wi-Fi product. So they did get a pretty good contract, and we are going to try to renegotiate that contract once we get into the property. But we have not included any additional income above what was in the T12 on the other income, which is why you saw on that one table that Danny was showing you about, the other income is not really jumping that much in year 1 and year 2. So we're being very, very conservative on that front. Whereas in most properties, those are things we're needing to do to increase that revenue. This one, we didn't need to do that, and we don't plan to do so.
Good. Well, as we're finishing it up here, does anybody have any further thoughts or closing? I was about to say closing arguments or something like closing points before we wrap it up tonight.
Pretty well covered, I think.
Good. Well, one last question coming in here is when will you start distributions? So this particular property, correct me if I'm wrong, Danny, but I believe it's a 51-day close, so 21 days due diligence, 30 days to close. So it's actually going to be the end of September or the end of August of a close. Is that correct, Danny?
Yeah. However the dates fall, end of August, beginning of September. So, distributions would start in either October or November.
If we close in September, they should start in October. So we'll actually start in November. So we always wait until we have a full month of operations under our belt. So I believe right now we're projected to close at the end of August.
August 26th
so that would actually
is
August
the date
26th.
right now. Yeah.
Okay, good. So August 26th is going to be around the time frame we should be closing. So we'll have our full month of September under our belt. We'll make distributions in October. If for some reason we end up closing in September, we'll wait till we have the full month of October under our belt, and then we'll distribute in November, just like we do on any of our other assets that we've acquired over the years as well. That way we can make sure that we can make those distributions to you, take over the property, and perform really well. So great.
And they're monthly distributions. That was another question that I fielded. I was quick on the technology.
Yes, these are monthly distributions. We've always done that as far as our properties, and we want to continue to do that. We feel it's important for our investors to see that cash flow coming in every single month, not only to receive the cash flows, but also so you can know that we are constantly and regularly looking at the cash flows of the property so that we can make those distributions on that monthly basis. Because if we only look at them on a quarterly basis, then sometimes that'll cause you to not look at the numbers as close. So we want to make sure we're looking at the numbers every single month, and so we're doing those monthly cash flow distributions to our investors because of that. So appreciate the bringing up of the distributions. It's always a question that does get asked. So I think that's all the questions that we have right now. So if for some reason you have a question that we did not answer, or maybe you didn't ask, feel free to reach out to us. We'll be glad to answer any questions that you have further, and look forward to having you participate with us here on this acquisition. First acquisition in Charleston. Really excited about it, and looking forward to this particular acquisition coming up in the end of August. So thank you, gentlemen, for joining us on the webinar. And again, we look forward to everyone on here investing with us and partnering with us on this particular acquisition.